This is part 3 of our special 4-part video series about the economic apocalypse of the 4 horsemen.
Everything mentioned in this video should be considered opinion only and not personalized investment advice.
We talked about debts and defaults of the follow-on effects from them, the counterparty risk. Now we're going to talk about part 3, very important, and this is something that has been manifested because of parts 1 and 2 and the way that we're trying to run this society. We've got detachments between stocks and the economy and fundamentals, all sorts of detachments. Detachments of opportunities, income disparities. And this part, this 4 horsemen part 3, could be called just as easily delusion. We're in a delusional market with detachments between fundamentals and the prices that the stocks are trading at, for example. There's all sorts of detachments, so I'll get into it now. But if you've seen recently what's going on with AMC theaters, GameStop, these meme stocks that are being driven up in price strongly. Now, everything I say in this part, keep in mind, every single artificial influence is always temporary. If you take one thing I say ever, if you ignore everything else I've ever said in my entire life, just pay attention to that. Every time something is artificial, it's temporary. This is from InvestmentU. And the reason I'm calling it out is I want to show you that they're talking about fundamentals, fundamental arguments. You guys know that my approach to investing is fundamental mainly, 80% fundamental analysis, 10% technical analysis with leads analysis, and 10% third level analysis, which is things like more qualitative, more like branding and the way that a product differentiates itself. That's very valuable, and it's one of the things that a lot of people don't look at if they're an analyst. But this says AMC, one of the Wall Street's biggest winners this year, the shares of AMC skyrocketed more than 2,800%. With most of the pandemic restrictions being lifted, and people are starting to return to theaters. Such a strange combination of thoughts there, where it's like they're talking about a fundamental reason that, well, people are going back to the theaters, and the stock price went up 2,800%. Let me tell you about AMC. We had a theater in town here that it went from Empire Theaters, Landmark Theaters, to AMC Theaters. They just keep going bankrupt, and all they really do, somebody comes along, buys them, and changes the snack bar. I'm sure they do stuff behind the scenes, but I'm just saying that, oh, new owner of the theater, and you go in there in the snack bar, and they've moved where they put the licorice. They're combining a fundamental argument for something which is absolutely not fundamental. Fundamentals did not drive the price up 2,800%. It was an artificial influence of a bunch of people buying all at once. And what happens? It's artificial, so it's right. Movie theaters are swimming upstream. It's basically like the industry for pipes and fur coats and monocles, phone books, xerox machines. I think that running a movie theater must be one of the toughest businesses besides running a restaurant right now. And the other one, another one of several actually, the big one was GameStop. The continued buzz surrounding GameStop on social media has driven up the prices, even though the company's closed 693 stores last year and plans on closing more this year. Despite that, the shares climbed more than 1,200%. Understand that 1,200% is absolutely detached from the fundamentals, and they say it's all thanks to internet hype. Message boards with over 10 million users can generate enough excitement to drive stock prices. Now say it my way. Can generate enough to drive stock prices artificially and temporarily. There's a big difference. This was a response I wrote to a lifetime subscriber of PeterLeeds.com. For numerous reasons, we are in a delusional market. Delusional markets can always get even more delusional, but they cannot remain as such for an unlimited amount of time. Reality will come back, and that will look like inflation and pension clawbacks and defaults on debts of all kinds, and mortgage and auto loan financing fraud, and further deterioration of the purchasing power of the US dollar, and major homelessness problems, and a stock market decline. Enough of this, it's depressing me. Let's go talk about complacency. When there's a lot of complacency, that means that there's a lot more risk for investors. Most big stock market crashes or downdrafts will happen when there's greater complacency.
Peter is not going to say it, so I will. Please subscribe to the channel.